What's up, guys? It is John from Side Hustle Experiment. Today's video, I have Chris Potter from Tall Oak Advisors. He runs a bookkeeping slash accounting firm for specializes in e-commerce. We covered so much stuff. We cover what you can write off as an Amazon seller, what you can't write off. Most of the common things you see on Instagram, on TikTok might not be telling you the whole truth. We talk about cash back, how that is treated. Is it taxable? Is it not? He gives his opinion on that. We talk about why inventory labs and seller board are good, but they are not the best for accounting. There's a lot of other things to consider. He goes into all of that. And he also covers he's looked at tons and tons and tons of Amazon sellers' books. He was an Amazon seller, and he kind of covers, I think it's 4 or 5 of the most common errors he sees. He said he's never seen an Amazon seller have their books done properly. So he covers what he's commonly seeing, stuff that you could correct. And even if you're not ready for an accountant or a bookkeeper, he kind of goes over what you could do. And lastly, he also goes over how you can find a bookkeeper slash accountant and what questions to ask them exactly. So much knowledge in this one. Definitely check out his links below. His Twitter will be there and his firm. Just a really great guy. I really enjoyed this interview and enjoy it. All right, what's up, everyone? I have Chris Potter here. He is the co-founder of Tall Oaks Advisors, and thank you so much for being here.
Oh, it's a pleasure being here with you today.
Can you talk a little bit about your Amazon journey and kind of what you're doing now, Amazon space?
Certainly. So I actually started selling originally on eBay back in 2005, but just part-time as I was having a full-time job. And I built into a full-time business 3 years later in 2008. And I was in the e-commerce industry from 2008 until 2020. And in 2020, I actually exited my Amazon business and I bought tax offices. I actually have 47 tax offices in Virginia and North Carolina. And now we're offering bookkeeping, CFO, and tax service to the e-commerce industry, kind of marrying all my knowledge from all of those years in the e-commerce industry. And it's a lot of it. It's a lot of knowledge because in that industry, I've literally done every business model imaginable you can think of. I've done retail arbitrage, online arbitrage, wholesale, private label, drop shipping. I literally did them all. So I have tons of knowledge in that field, and that's kind of a very, very quick story. I can go probably about an hour in that entire story because there's so many years of information there, but that's the general gist of it.
Cool. Yeah, no, what made you want to get into like accounting? Were you into it or do you have a background in it or
So I actually back in school, I actually took accounting classes back in school. It was one of the fields I thought I may end up getting into was actually accounting. And I enjoyed entrepreneurship way too much, so I never went down that path. But because I had that background in college and in school, it basically passed with me when I owned my businesses. And every business that I owned since then, I've been very, very heavily invested in the finances of it, understanding the finances, understanding the bookkeeping, all that sort of a thing. And over the years, I've taken various courses as far as bookkeeping courses, chief financial officer courses. A lot of that I've done over the years to kind of keep up to date on those things. And it just very interests me. I love numbers and it's always been kind of part of my thing. So when I exited Amazon and I saw these tax businesses were available for me to purchase, it was kind of a seamless movement into that industry.
cool? Yeah, no, it's always interesting too because people are just like, oh, like what happens if like Amazon fails or it gets suspended? And it's just like there's so many companies who want to like explore the space or like there's just so many opportunities and you applied it to accounting and now I have this whole thing.
Yeah, definitely. When you mentioned suspension, that's very close and near dear to my heart because at one point in time we had 15 Amazon accounts, and we did that. Yeah, we did that because of this potential suspension risk, because we were doing a lot of different business models and we sold a lot of products, and we tend to get at that point in time, people are very loosey goosey on setting in IP violations, and it was very difficult to get them untaken at the time. Obviously, the process is a lot better these days, but we're talking probably 5 years ago, 6 years ago, when it was a much bigger problem. and we would just have accounts continuously get suspended. So we basically kept getting more accounts we bought from previous owners, and we did that so that we can spread the risk. So I know that really wasn't the question, but when I hear the word suspension, that just kind of rings in my thing because I had to deal with so many suspensions over the years. I've had to spend so many like reinstatement things to seller support. Every time I hear it, it just rings a bell in my head. That's like, oh boy, here we go.
Yeah, no, anytime I hear like IP, like it's just like oof, like I don't like.
Yeah.
I feel like there's lots of maybe not a good understanding with Amazon sellers or people in general when it comes to accounting. So can you kind of go over the basics, like what's gross profit, what's net profit, and kind of like what's ROI, and kind of, I mean, I'm sure you see stuff shared on Twitter and stuff like that, and maybe take that, be like, hey, that is not profit, and kind of walk back.
Yeah, certainly. So I'm going to give one preference ahead of time because I know that we're probably likely going to talk a lot about tax related questions, things like that. I personally am not a CPA. However, I know a lot about taxes. I have CPAs on my staff as well. So all the various questions we're talking about today has been verified by my team. But keep in mind that what we're giving here is not financial advice. And that sort of thing. I would recommend talking to a qualified financial advisor or CPA. But I would like to get that disclaimer ahead of time. But the information is mostly coming from my experience over the years and also having people on my staff to understand this. So back to your original question about gross profit, net profit, ROI, that sort of thing. So the main thing as far as gross profit, that's pretty simple. It's just sales minus your cost of goods sold. And again, we're talking specifically about e-commerce because I know that's what your audience is. And obviously, we have different industries that it's a little bit different, but specifically for this industry, it's pretty much as easy as sales minus cost of goods sold. Now, one thing I've seen that a lot of people get confused on as far as what's actually included as part of cost of goods sold. And obviously, the buy cost is part of that. That's a given. But the thing that people tend to not realize is that prep center fees and prepping items, unless you're a manufacturer, it's actually not part of cost of goods sold. It's an actual expense. So what I've seen some people do is they actually take their buy costs in inventory lab and they'll add in their prep center costs as part of that buy cost and put it in there. And if you're trying to utilize inventory lab as your sole source of bookkeeping, which I think we're going to talk about that a little bit later, that is one big mistake that you make because it should be split out as far as an expense and cost of goods sold. So as far as like gross profit, pretty easy, sales minus cost of goods sold. Net profit is now your sales minus all of your expenses total. So it's kind of a difference between those two, and sometimes people get it confused. Realistically, when you hear bottom line profit, that's your net profit. It's typically what you see. And an ROI, which is a number that is thrown around a lot in the industry, mostly because when you look at any sort of sales tool, it has an ROI number. Look at inventory lab, look at seller board, they all say ROI. And pretty much that's just estimated profit divided by cost of goods sold. And it's a decent number because you're kind of looking at, how much is your cost of goods sold and you're dividing it by how much profit you're going to have. And it gives you a pretty consistent number to make decisions off of. So it's not a terrible number to run with, but it's one of those cases where in any other industry, you don't really hear ROI used in the term that's it's
Yeah.
used in the e-commerce industry. It's just, I think it was just sensationalized by a lot of these tools that they kind of included in it, and everyone kind of ran with it and was like, "Oh, this is a great way to do it." But yeah, it's a case where it's a great number, but you know, as long as
Yeah,
you're
I
using
think
it
it's
for
a better
tangible
number when you
purposes.
see like 30-40% instead of like $2, $3.
Yeah, and what's funny is that $2 and $3 at 30% ROI is like really rough. So it's one of those cases where like if you're 30% ROI and you see a profit of like $20 and you're like, okay, not as bad, but 20% with a dollar profit, ooh, that's a little
Yeah,
rough.
not good. But what is ROIC?
All right, that's a great question. So ROIC is a concept that comes from the big world of big corporations. So when you're talking about corporate finance, ROIC is a number that they typically use. They typically use it with another phrase. It's called WACC, WACC. And so the difference is ROIC is return on invested capital. And the easiest way to explain it is that it's how much profit you've made off the inventory or asset you're holding. So in the e-commerce space, it's how much profit did you make on a regular basis with the inventory that you actually have invested. So if you think from an example of I have $100,000 invested into the business and inventory, how much profit does that $100,000 actually generate me in a given time? And that's pretty much what the basis is. WACC is the other one I talked about, which is weighted average cost of capital. You don't need to know the term. But basically, what that boils down to is the interest rates you're paying on your debt. So let's say, for example, you have $100,000 of inventory, but it's not your own money. You're actually loaning that from Amazon, or you're loaning it from a credit card advance, or who knows where it's coming from, and you're paying 20% interest on it, which is pretty high. Some, I would say like Amazon loans are closer to like 10 or 13, somewhere around there. But realistically, you're kind of comparing it to, and your goal should be is that your return on invested capital should be higher than what the debt service is, how much you're actually paying out. So I'm trying not to go too far into the weeds here, but the easiest way to kind of calculate this is just to take your profit that you make and you divide that by your average inventory valuation. And I actually have a thread on Twitter that kind of like outlines the exact way to do it. And I could probably talk for 15 minutes on this, but realistically, if you go to that thread, it kind of like outlines exactly how to calculate it, understand how to use it in your business. But the general way to think about it is that it's a more accurate way to really take your ROI number and really understand how it works over time and how you actually utilize that information within your business is it allows you to spot trends, because what you may see is that your return on invested capital 1 month might be 20%, but the next month it's only 8%. And then you're like, okay, well, what the heck happened? And in a lot of cases, it's because your stuff didn't sell quickly enough, products tanked, your margins eroded. There's various reasons you see there, but it alerts you that there's a problem somewhere, and then you can start triggering and figuring out exactly what it is. And in that thread, I mentioned like various things that you can look at if you do that. So I definitely recommend looking at that, but because it's a pretty complicated measure if you kind of look at it as a whole. But it's a very, very good question. I think it's something that every Amazon seller should be aware of, and it's something that a lot of people just aren't.
Yeah, I've never heard of it, and I don't even know the tool if it calculates it. I thought that was really interesting. When it comes to accounting, obviously inventory lab, seller board. I just heard this other one the other day, sales cyclops or something. I don't even know. But what are they kind of missing, or like why doesn't that tell the whole story, I guess, of your business?
I think Profit Cyclops is the one you're referring to.
Yeah, profit
I believe
cyclops.
it's Profit Cyclops. So, yeah, it's a very good question. All these tools are absolutely great tools for what their intended purpose is. And their intended purpose is to give you management tools to be able to operate your business. And that's what they're designed to do. They're not designed to be accounting tools. And so what happens is that you see a lot of Amazon sellers just rely on those tools for their sole accounting tools, which is an issue because it's not what they're designed to do. They do a pretty decent job as far as giving you relatively accurate P&Ls and profit and loss statements, and it gives you some insights on your ROI numbers, your relative margin numbers, your profit levels on individual sales. You can look at your supply, by supplier. You can look at it by SKU. Lots of great data that allows you to make your decision making based on those things. But what it doesn't do is it doesn't give you any sort of actual accounting mechanisms. So the biggest problems we tend to see with these sorts of pieces of software is that there's a lot of human error in it. Absolutely, human error is the biggest one. And the errors we typically see a lot is think about how many touch points you have with these pieces of software. The biggest touch point you have is buy cost.
Yeah.
and and what tends to happen is, especially if you start having prep centers involved with it, you start having more than one person entering in the buy cost. You start seeing transposed numbers. You start seeing incorrect information in there, and that immediately just totally throws off your cost of goods sold, totally throws off your inventory valuation right off the bat. And it's a very high touch point, very prone to error. Then you have the other fact that they only really know what's going on Amazon. It doesn't know what's going on your credit cards, doesn't know what's going on your bank statements, doesn't know any of that. And so what tends to happen is that if you, again, a human,
Yeah.
makes an error and doesn't enter in all of your expenses, which is extremely common with people who use these tools, then you don't have an accurate picture of what's actually going on in your business. And so that's really the biggest problem. And then the other issue is that they're not in line with generally accepted accounting principles, which is what's required for doing taxes. Now, keep in mind, we can do taxes if all you have is Inventory Lab or some of these other tools, but it's not going to be as accurate as it would be if you actually use a proper tool like QuickBooks or Xero. Wave's another one some people use, but obviously the big two are either QuickBooks or Xero. And the issue you tend to see is that you end up not getting enough deductions, you end up paying more in taxes, and you're also, if you were to get audited, it's going to be an absolute nightmare. So that's kind of the big gist on Inventory Lab. But absolutely great tool. I would definitely recommend, even if you are getting an actual accounting tool, still use these tools. They're absolutely great for management purposes, for making decisions within your business. but you still need some sort of accounting software to actually do it properly.
Yeah, it was actually, I don't think it was it. It was until I came across, I think your Twitter and I think Arbitrage Ops, the Discord group.
Mm-hmm.
And yeah, it was always just kind of like one of those, I don't know, Amazon myths or whatever you want to call it, where it's just like, oh yeah, like just get inventory labs. Like if you have inventory labs, like yeah, it's great for management, but like that's how you'll know your numbers. And it wasn't until they're like, oh, like kind of, sort of, not really. And then I was like, oh, let me look more into this. And I was like, oh wow, like there is a
Yep.
lot more that goes into this than just what's put
Yep.
in there.
Yep, absolutely. Yeah, absolutely. Especially if you start, if you start looking at a lot of different areas, the inventory lab just doesn't cover like depreciation or any other accounting methods. Like none of that's included in inventory lab. And you don't get balance sheets, so you really don't know how much equity you have in the business. You don't know, are you underwater at any given time? You don't get any sort of cash flow statements, which is what you also get through those sorts of actual accounting tools. So you're missing a ton if all you're doing is inventory lab. And I would definitely recommend going with an actual accounting software.
Do you ever have like a desire to like create something like an inventory labs that could like almost work for accounting, like your own software?
No.
Okay. Yeah, I didn't think so. It
No.
sounds very complicated.
It's extremely complicated. And you have to think that, there's a few big players in the industry, and the biggest player is QuickBooks, which still hasn't even really made a tool that really works with it. And if the biggest player in the industry that has billions of dollars and they're on the actual stock exchange hasn't put money into it, uh, either the market isn't big enough or you don't fully understand it. But there's also so many complications because now you also have to think about, okay, if I'm incorporating credit cards, now I have to have an API connection with every single credit card bank that's out there and every single bank that's out there. And these are things that QuickBooks and Zero have done over time. They've created these things. And so that's just like one piece of the connection. Then you have to stay up with all the different law changes with how that works and keep that in the software. And on the other end, you got to stick up with all the Amazon changes. We know how much of a mess that is. So
Yeah.
I can understand why there's no tool out there that really does it 100% right because it's ridiculously complicated to do it.
Yeah, no, I definitely agree with you there. I saw in one of your tweets you said that you haven't seen an Amazon seller who's done their books properly. I think you said you looked over, I don't know, like 100 this month or something like that. What are you seeing that, like, what are they not doing correctly? Like, what's missing or what's going on
Yeah.
there?
Yeah, definitely. So yeah, the 100 number you're coming from is it's over the last 4 months. I do strategy sessions with potential people that want to work with us on bookkeeping, and we typically spend about 45 minutes together, and we discuss their financials. In some cases, I look at their books, and so I've seen a lot. I've seen a lot just even over the last 4 months. And the biggest ones I tend to see, the absolute number one problem I see across the board is that when they're using, and again, these are people who are using QuickBooks, and so theoretically their book should be good. What happens is that deposit comes in from Amazon, and they just get classified as sales. That's what they're doing. And if you think about it from a logical perspective, that is the number you get after Amazon already took all of their stuff out. So it's not the actual sales. The sales is the top line number, and then you have all of your fees that Amazon has taken out, whether it's storage fees, FBA processing fees, merchant fulfilled fees if you're doing any merchant fulfilled, your monthly subscription fees, pay per click fees, you kind of add all those up. That's when you get your number. And so when you just classify it as straight up sales, you're missing a lot of the picture. What tends to happen is at the end of the year, when Amazon gives you your 1099 form that outlines how much sales you have, there's this huge gap between it. And the reason is because they entered them all in as sales, and that's not the proper one. That's by far the number one mistake we see a lot. A lot of people do that. And we've even seen bookkeepers do this. So it's not just sellers. Like I've seen bookkeepers do this, and it's because they're just not familiar with e-commerce. There's a lot of people that just don't understand the industry, and we see this a lot with small mom and pop shops or like one person accountants or things like that who are great accountants by all measures. They're probably great bookkeepers, but they just don't understand e-commerce. And it's the same thing with a lot of Amazon sellers. They try doing their own books. You run into the same problem. So classifying Amazon sales is the biggest one. The next one is they don't reconcile any of their accounts. If you're unfamiliar what that term means, it basically means to take your bank statements and make sure they're right in QuickBooks in your software. Make sure all your transactions are right. Make sure they balance right. And people just ignore it. So that's a very big part of accounting is that you're required to double check everything to make sure it's right. So if you're not actually doing that, you're missing the entire double check process, which gives you no verification that what you've done is actually right. So that's another biggest one. And then there's like other smaller ones, like they don't classify transactions properly. They're not using pays for vendors. They're not setting rules to make sure things are consistent. So we see cases where you'll see uh, you'll see a transaction come in for the same vendor or the same place you're buying it from over months. So you'll see like 6 months they bought from the same place over 6 months, but then they classify half the transactions in one account and then half the transactions in another account, which they're all the same exact thing. They're all buying the same thing. They're either buying an inventory asset or a subscription service or something, but for some reason they pop into two different categories. And the reason why that happens is because they don't have consistent rules behind doing that, which again is improper use of books. So those are the five things I would say they're probably most common. With the absolutely biggest one I see on probably 70, 80% of ones I look at is that first thing I talked about as far as classifying inbound Amazon sales, inbound deposits as sales.
Yeah, no, I definitely, that's kind of why I like kind of sought out help because it was easy when I had a book business first. It's like you buy like a certain tons every month, like your sales, like it's not like, oh, you lose inventory or this or that. It's
Yep.
like, this is what you get, like, this is what you made, and like that was it. But oh, hey, it's much more complicated than that. And yeah, I first got QuickBooks. I was using GoDaddy bookkeeping, and then they just like stopped. And then I went to get QuickBooks, and I was kind of in the transition of like doing books to OA, and I was like, like I don't have time to do this or whatever. And like kind of watched a YouTube video, and then like everything was being classified as like assets because it was inventory. And then I was like, there's no deductions here. Like I don't have like $500,000. Like I don't understand what's going on here. And then I was like, oh, like it has to be like I was like, oh my God. Like so now I'm like back on the right track, but
Yep.
definitely complicated to like get set up and situated.
Yeah, people think it's a set and forget type thing where you just install QuickBooks and bam, it's done. And I can tell you that is far from the truth. We have, we hire bookkeepers obviously because we have bookkeepers on our staff, and I can tell you that there's even people that supposedly say they have e-commerce background, and we put them through various tests to verify their knowledge, and they don't even understand a lot of the stuff. And so if we have people who theoretically do bookkeeping all the time, don't understand it. Imagine someone who has spent 90% of their time trying to learn how to do sourcing to
Yeah.
try to do the books. I mean, it's kind of crazy, if you think about it that way.
Yeah, that's what I was like. I'm never gonna be as good as someone I hire, so like they could have it. So when it comes to cash back, is there's all sorts of stuff around this. Is it taxable? Is it a rebate? Like, what's the deal with that?
Let's put it this way, it's a very gray area, which is the reason why you have a hard time getting a proper answer out of anyone. And the reason being is that when you specifically look at the IRS tax laws and you look at the way that they tell you that things are supposed to be taxed, specifically when you have cash back and it's assigned to a business, it is considered a rebate against whatever purchases you made off of it. That's what they consider it. However, if you have credit card rebates and any sort of rewards that come back from credit cards, those are generally considered to not be taxable. There's actually been there's different publications that specifically have said this. So there's no gray area at all. If it's a credit card reward, absolutely is not taxable. It's the cash back and it's credit card rewards that are specifically cash back that tend to be very gray. And the reason why is because it really boils down to how you look at it. And because, for example, when you do your cash back, you are buying it, but you're buying items that typically people would normally buy, especially for OA. I'm specifically referring to online arbitrage because that's the majority we see this with. And typically you're buying from places like Nike or some of these other stores that give you cash back. And so you have to look at it from a perspective of, if you do Google search and you do a search says, is cashback taxable? They'll say no, because they're assuming that you're using it for personal purchases. And so if you went to Nike.com, bought something on your own, got the cash back, absolutely not taxable. It's not. The problem is that as soon as you introduce it being something for resale, it's supposed to be part of your cost of goods sold. However, now you run into when you do get the cash back, it's not in the company name. It's to you personally.
Oh, right, right, right.
In most
Yeah.
cases, it's to you personally. It's not to the company name. So Is the cash you get to you personally, or is it to your business? I don't know. If you bought on a personal credit card, but then use it for business, it's a gray area. I mean, you can construe this any way possible. You can say it, but there's no real there's no one out there that I've seen. There's been no IRS guidelines out there to specifically say how cashback is supposed to be treated in these scenarios. And I've also seen no cases where someone has actually had an audit and they end up clawing back all of this cash back and have taxes. So it's one of those cases where, you could ask five different accountants their answer on this, and they'll tell you five different answers because it's a very, very gray area. And what typically happens for most people is they just take the cash back, shove it in their personal account, and it disappears into thin air like it never happened. And part of the other thing that throws it off too is that none of these companies issue 1099s. So the IRS doesn't even know that these transactions even occurred unless you were to get audited or look at your bank accounts. So that's also another reason why a lot of people say, well, if you didn't get 1099s, that never happened. But again, there's a law for that too. Believe it or not, on the laws, there is a law that says that if you stole property, you have to pay taxes on it. So, if there's a law in the books for that, you know,
Yeah.
then you have to think about it is that even if you didn't get a 1099 for it, theoretically, if it's income, you're supposed to be taxed on it. So again, it's one of those cases where it's a legally gray area, and realistically, how you want to handle as a business owner is totally up to you. Just keep in mind that if you specifically tell your tax advisor, yeah, I had cash back, and they say you're supposed to have that as taxes, and you choose to not do that, you're actually putting your tax person at risk, because if you were to ever get audited, they have to defend you possibly, and they have to tell the truth on what happened. And if they say that they, told you this and then still did a tax return even though you said this, it could potentially put their ability to file taxes in the future at risk, which is the reason why you see a lot of accountants be very strict on this. And so again, it's one of those cases where risk tolerance level on the business owner, understand where the guidelines are, and make your own decision on how you want to handle it. It's kind of what I typically tell people. And if me as a tax person doesn't know about it, what can I do about it in that case? So I'm not going to give you yes or no answer. I'm not going to give you a straight answer because this, you can kind of read between the lines what I'm saying there. But again, I'm not a CPA. I'm not a tax advisor. I'm not, I'm not a legal person. So you can take that with a grain of salt. But that, from what I've seen over years of people using cashback, most people don't claim them, and they just throw them into their business, their regular bank accounts, and they disappear into thin air.
Yeah, that's kind of what I've like heard or kind of thought of it. In your opinion, I know you've had strong opinions about kind of opportunity cost and when to liquidate inventory, when not to liquidate inventory.
Yep.
Can you go a little into that? I really like your take on it. And most people don't talk about like the cost of like holding on to it.
Yeah, I see this a lot with older sellers actually that have been around for multiple years, and they have a lot of inventory. And what tends to happen is that over time, and you're kind of blind to this usually when you start because you're kind of just selling through stuff. You're trying to sell stuff as quickly as you can, and you're kind of blind on some of that stuff that doesn't sell. So what we see in some cases where, let's say you bought $100,000 of inventory and your sell through rate is, let's say, 80%, which is extremely high.
Yeah.
That means there's still $20,000 of inventory that didn't sell during that first month, and now you still have to obviously have money to support that $20,000. Now the question is when does that $20,000 actually sell? And what tends to happen is in some cases that little bit of product kind of gets ignored because like you're still trying to buy new stuff, you're trying to find new deals, you're trying to find all of this, and that $20,000 ends up just kind of like swimming along, and you're like, huh, why is my bank account so tight? And and then why do I need to get more loans? Why do we need to do this? And what tends to happen is that money just kind of like just sits there and it just erodes and it keeps getting worse and worse and worse because products tank, stuff goes out of style. There's various reasons why stuff doesn't sell. And so realistically, as far as like the way I kind of look at it is you kind of have to look at the way that number one, how Amazon wants you to treat your inventory. And number two, what's the financial incentives for you to actually move the inventory? And three, from an overall business perspective, it doesn't make sense to liquidate. So if you look at specifically from Amazon's guidelines, especially on the 19th, which is in 6 days from the day we're recording this, they're changing guidelines around how much the actual cost is for you to let products sit in their warehouses. It's quite obvious they don't want to store your product. They want your stuff out of there within 60 days. And
Yeah.
so my thinking is that if Amazon wants it out within 60 days, why would you want to hold out to any longer than 60 days? Is the way I look at it. Because they're going to start heavily penalizing you once it's after that mark. And the older and older it gets, the worse off it gets because if you think about it this way, is every single month you're getting hit with these fees to store the product in Amazon,
Yeah.
and you just continue to pay these fees. Yeah, it's just sitting there, and pricing might go down. And some people like, oh, it's going to come back.
Yeah.
Half the time it never does. Half the time it never does come back,
Yeah.
and you really have to kind of weigh those costs on it because if I have that say $20,000, it literally sat there for 6 months. What could you have done with the $20,000 to generate more profit?
True.
If you let it sit there for 6 months, you're paying all those fees. Maybe the pricing has gone down, so that $20,000 is now only really worth 15,000. And then by the time you factor in all the fees you paid for letting it sit there, maybe it's not only worth like 12,000. And by the time you end up selling it all off and getting your money back out of it, you might only get 12, $10,000 out of that original $20,000 spent. When realistically, if you would have just discounted it right away, maybe end up getting even if you discount it so hard that you got your 12,000, you only got $12,000 back in month two versus month six. Now you have 4 months to turn that $12,000 into more profit. So that ends up being more profitable by getting rid of it sooner than holding on to it and letting it sit there. So my general guidelines are 60 days. You start using some sort of liquidation procedure, whether that's discounting it 10% a week, whether it's starting to do pay-per-click advertising and try and get it moving. But basically, you do something to get it moving at the 60-day mark, and then just continuously hit it once a week. If it hasn't sold within a week, you discount it again. Has it sold within a week, or whatever you need to do. In some cases, discounting doesn't solve the problem, but you just have to figure out like what it makes it move. Do you need to like fix the listing? Is it you just need to figure out what's going on with it in that case, and then come up with a plan of how you're going to attack those products. And that's pretty much missed by a lot of Amazon sellers is they just don't come up with any sort of strategy when stuff doesn't sell, and it's detrimental. It's absolutely detrimental.
Yeah, that was my biggest problem when I first started. I was like, oh, I had a repricer, and everyone was like, oh, like keep prices high, like don't take the price. So I didn't turn it on. And then like what I quickly realized is like after like a month, it was like, oh, like this is no longer profitable. But if I had like the repricer on, I was like going up and down, like as the price moved, then it would have been profitable. Then I was like looking at like I had to like basically liquidate everything, and I was like, huh,
Yep.
like didn't really think about this.
Yeah, and the biggest hurdle I see a lot is that they're saying I don't want to lose money on it. So they see it's non-profitable now, and they're like, well, I don't want to lose money on it, so I'm not going to drop the price. And when a lot of people just don't realize is there's hidden factors behind it. You've got the cost money of time that if you had that money back, even if it is less, you can invest in something else. And plus, it's money in your hand now. If you just let it sit there for another month or two, you don't know if it's going to sell in a month or two. It could sell 3 months from now. You could get, Amazon could come in and flatten that specific brand because they want to brand restrict it, and then you have no chance of selling it. And then you have to remove it, and you have removal fees to get rid of it, and there's a lot of factors that come into play when you have a product just sitting there. And the quicker you can get that stuff out, the better decision making you can make on future products. And I know people don't like tanking prices, and I'm not condoning just randomly tanking prices. You want to basically take what the market gives you. And if you get to the point to where you're saying on product and it's not moving for various reasons, price might be the thing to get it moving. Because I've seen cases where people price stuff at like $50 and it's selling okay at $50 and it's ridiculously profitable. ROI might be, 60, 70%. But then you drop it down to maybe a 30% ROI, and now the thing sells 5 times as fast. And you have to make a cognizant decision of do I hold out to get these, or do I just kind of get this bad boy running so that way I can get my money back out, invest into something else that's going to make me more money.
Cool. What are some things that you could write off as an Amazon business?
Good question.
Yeah.
So So I'll kind of go through the list of just like very most common things, and then there's some other things that are kind of dependent on situation. So some of the most common things I'll rattle these off really quickly. So you've got software, VAs, payroll, shipping supplies, prep center costs, insurance, pay-per-click, inventory reimbursement services, uh, interest payments, warehouse office expenses, Business coaching is another big one. Continuing education. So when you buy those courses and you're doing those sorts of things, that's a tax write-off. Repairs if you need to make them. Equipment is also deductible, but keep in mind that it has to be under $2,500. Once it's above $2,500, it still is a write-off, but then you have to deal with depreciation, which is a fancy way of saying you can write it off over multiple years as opposed to that first year. So just keep in mind if you're looking at buying some sort of equipment and you see something that's like $2,400 versus $2,600, you probably want to buy a $2,400 one so you get the write-off right away. So those are kind of the most common ones that we see for Amazon businesses. They're pretty, decent sized list there. A couple other ones are dependent on situation. So one would be like home office. If you work out of your house or work out of an apartment, you do get a home office deduction, which effectively takes all of your expenses you've had at your house. You figure out the square footage of your house that you've used, and then you get a percentage based on those numbers. So you get a deduction for that. You get mileage for your vehicle if you're using it for business purposes. You get mileage for that as well. Restaurants is another big one that's situation dependent. Of course, it should be business related restaurant expenses. Same thing with travel. They should be business related. And I can go into a whole thing about travel, but the key thing being is that travel needs to be a specific business purpose and it should be more days of business than pleasure. So if you're going on a 7 day trip, it should be 4 days worth of work, 3 days worth of pleasure if you're going to do it. And theoretically, the pleasure should be in between. So it should be 2 days work, 3 days pleasure, 2 days work on the back end. That's kind of the generalized rule of how that should work. And if people are in kind of in an RA business, a retail arbitrage business, they're in a very unique situation where they realistically can source from anywhere. So if they have scenarios where they want to do some sourcing in a different state that they live in, which is a good vacation spot, you can write off your entire vacation if you're doing some sourcing on the trip. And there's some people I know that literally pretty much live on the road and they do nothing but sourcing and they basically get to write off all their hotels, they get to write off all their mileage and all their meals because they're on the trip the entire time. And that's how they buy their inventory. So that's just kind of like a little wrinkle you can play into if you're in this style of business.
It's amazing. What are some things that people say on Instagram or Twitter that kind of drive you nuts that you really can't write off, but people claim you can?
So there's two specific ones that are consistently hit hard on Instagram, TikTok, and other places. The two big tax write-offs people talk about the most are vehicle expenses is number one, and then the other one is the Augusta rule. People like to talk about that too. So vehicle expenses is the big one because what you'll see is people talk about the Section 179 is what people will talk about on TikTok. And my guess is if you watch any TikTok videos of anything about taxes, they probably talk about Section 179 in some fashion. And just to kind of give you an idea of what Section 179 is designed to do, is it's designed to take some sort of asset that you purchase. It's a very large asset. In most cases, vehicles, what we're referring to, and it allows you to depreciate it or write it off, depreciation write off, whatever you want to say it, that first year versus spreading it out over a certain period of time. And what Section 179 allows you to do at that first year. So what people tend to say is, hey, if you think you're going to owe a huge tax bill, go buy a G Wagon in December, and that allows you to, write off $100,000, and now you have a vehicle. But the problem with that is that that vehicle is supposed to be used for business purposes, and it has to be used for business purposes for at least 50% of the time. And if you're using it for, let's say, 60% of the time, you're supposed to only write off 60% of it, not 40%, not the whole 100%. And so what tends to happen is that people say, I'm going to get a G-Wagon, I'm just going to drive it. And yeah, it's business purposes, which is technically tax fraud. So, so it's one of those cases where, they don't tell you the whole story and a lot of these. And yes, it is a legitimate, tax write-off. But think about it this way, is that if I'm an IRS person and I'm looking to audit people, right, I'm going to look for these very big red flags that are going to throw out there. If someone buys a $100,000 G-Wagon and their profit for the entire year was $130,000 and they wrote off $100,000 of it for this G-Wagon, does that look like a red flag?
Yeah.
And so that's one of those cases where you really have to be cognizant of it. I mean, if you're making $1 million a year, totally legitimate write-off that makes a lot of sense. It's probably not going to raise a red flag. And if you're making $1 million a year, you probably are doing a lot of business and you probably do a lot of business travel. So it makes absolutely perfect sense in those scenarios. However, for a person that's not making a ton of money on it and they're doing that, and the other thing I think about too is that this stuff isn't free. It's not like, it's
True.
not like, especially in an inventory-based business, like I hear it all the time that like they have no money because they're consistently putting it into product. They need loans, they need credit cards, they need all this because they have to keep feeding the beast is a big term. And so how exactly are you going to find money to pay for a G-Wagon? Obviously, you can get loans. In that case, you're probably talking $1,500 a month or $2,000 a month, whatever it happens to be. And like, it's like, can you really afford it too? Like, yes,
Yeah.
it's a tax write-off, but can you actually afford to do that? You know, and so those are things they just don't talk about. So that's a big one. Augusta rule is another one, which basically is a fancy way of saying that you can rent your house out for up to 14 days a year and not have to pay tax on any money you make off of that. Perfectly legitimate business expense. Perfectly legitimate tax deduction. What some people then say is, well, you can just rent it out to yourself. You can have your business rent it out to yourself. Yes, you can. However, there has to be legitimate business purpose for this. So if you're going to do that, not to mention, you can't be working out of your house and still have this tax deduction. You have to be in a warehouse, you have to be in an office, and then you have to have some sort of event at your house that may have it make sense for you to rent it out to yourself. So that would be like a corporate retreat or monthly business meetings, board meetings, things like that. So you can do it, but like the way these videos sometimes talk about it, it's like, oh yeah, you can write this whole thing off. And it's like, it's a less than a minute video and they're not talking about any actual like reality behind it. They're getting people all excited about this huge tax deduction they can get. But it does make sense for certain scenarios, but for a majority of people, it's not a legitimate tax deduction. It's just getting clicks on TikTok and getting views is all it's really doing. That's a
Yeah.
big one.
It's funny.
Let me throw one more out there
Oh yeah,
because
throw
there's
one more.
out there. Another big one is entertainment expenses. People seem to think that they can go to the club or go to a bar and like pay all their people's tabs. They can write it all off. Entertainment expenses are not deductible. They were prior to 2018, but they're not deductible anymore. The Tax Cuts and Jobs Act eliminated entertainment. So even like if you buy tickets to a baseball game, they are not tax deductible anymore. However, if you buy meals at the ball game, assuming as a business meal, like your client invited you to go, or you invited a client to go, then you can write off the meals while you're there, but the actual entertainment expense is not deductible. So that's kind of the other big thing. And obviously, things without documentation or a real business purpose is another one that you have to kind of think about too.
I actually saw one on Instagram, and it was kind of like I don't know of this person or whatnot, but they were basically saying that their accountant said that the bottle service is a write-off if you have like a light up sign that says like your business name or something, because then it's like an entertainment. And I was like, I don't know about that, but
Yeah, I mean, there is a specific rule in there that says like if your business is specifically in this style of business, then theoretically you can, but it's a very, very big edge case. And one of those cases where like most of the times it can probably just get thrown out in any sort of audit. And again, it's one of those cases where you have to determine where your risk tolerance is. And I can tell you that like that's not a place that we play around in. I've seen people try and write these things off, and they're not tax deductible, so we can't write them off. And yeah, there's these fancy ways you can theoretically do things. You can spin it up, but in an e-commerce business, like no,
yeah,
come on, man.
yeah, it's yeah, no, that's like yeah. So I'm like more of like I just like to play it more safe and then be sorry later. I guess we'll wrap up with this. Two more questions. So, what is the proper way to almost factor in discounted gift cards? Not buying them with crypto or doing any of that weird stuff, but the
Yeah.
legit way. How would you put that into your buy cost, or how would you look at that?
So it depends on how you're actually doing your accounting. Remember how I mentioned the inventory lab and those sorts of tools are not designed for accounting purposes? This
Mhm.
is one way that inventory will absolutely fail you because there is no proper way to do it in inventory lab. There's absolutely no way to do it proper accounting procedures. There's no way to do it. So if I was only using inventory lab, the way I would do it would be to basically take your buy cost. So let's say your buy cost is $100 and you bought a gift card for $100, but you only actually paid $90 for it. Then I'll actually change the buy cost to $90, whatever that percentage is. So if it's $10 discount, 10% discount, I would then take 10% off my buy costs, and that's what I would put into Inventory Lab. That's realistically the most efficient way of doing it in Inventory Lab, because ultimately the way it happens in accounting speak, technically a gift card is a gift card asset, and you're supposed to have an actual inventory on that. And then whenever you use the actual gift card, then it converts to an inventory asset. And then when you sell the inventory, it turns into cost of goods sold. There's this huge chain of events that's supposed to happen when you do this. For practical purposes, we typically just leave it as an inventory asset, and then we do a cycle count at the end of your month or quarter or year, and then we just make an adjustment at the end of those time frames. Is typically how we do it. But that's something that obviously you don't have to deal with if you're paying someone to do your books properly. Then that's something that they'll handle. But for inventory lab purposes, sticking to the buy cost is the most elegant way of doing it.
Cool. And the last question, what is one of the best ways to find a bookkeeper or kind of know if you're ready for one? Just kind of got a lot of people ask, how do you find one?
Yeah,
Um,
certainly. So as far as on the bookkeeping side, realistically, in most cases, I'm a very logical person. I understand. I've started a lot of businesses, so I understand the cash is extremely tight when you first start out.
yeah.
And I would say, from an accounting perspective, start your bookkeeping day one. But I'm also practical, and I understand that trying to pay someone to do your books, if you don't understand them right when you start, is a very difficult call, because you're possibly not profitable yet, or you're barely profitable, and you're taking every dollar and you're shoving it into inventory. So generally, I usually say that once you start getting to about the $40,000 to $50,000 a month mark is kind of when it really makes sense for sure to do bookkeeping. We do have some clients that do it before that, and if you're private label or some other areas that have more profitability, then the lower levels make sense. And if you're in a different industry, it makes more sense. But when we're specifically talking about e-commerce, that's kind of like the level where it absolutely makes sense. It can make sense in lower levels, but that's when it absolutely makes sense. If you're doing above $50,000 a month and you're not doing accurate bookkeeping, you probably should. uh, if you're underneath that, then you're kind of here or there. But absolutely, if you're not doing that, absolutely get Inventory Lab or some other tool. So at least you have some method of tracking that we can use for tax purposes. Because otherwise, you're in really rough shape if you literally don't have Inventory Lab, don't have nothing, you've done no tracking at all. And we have some people do this to come to us, and you're dead in the water, because then what you have to do is then you have to go through every single credit card statement, every single bank statement, add them all up, and figure out what you did. And I can tell you that sellers do not like doing that.
That's terrible. I had to do it this year.
Yep. Yep. So that's as far as you know. Now, as far as like how do you find one, right? So the thing to keep in mind is that you're in a very specialized industry in e-commerce, and there's a ton of accountants, a ton of bookkeepers out there. A lot of them are very good, very, very knowledgeable, but a lot of them know nothing about e-commerce. And so what you have to do is you have to make sure that the person you're working with legitimately knows your style of business, legitimately understands your business, so that way they can give you the proper bookkeeping and tax advice as necessary. And so some questions you would definitely want to ask. Number one, I would definitely put together a list of questions you want to ask them ahead of time, and then look for a few different providers and just interview them, just talk to them, find out if you like them, that sort of thing. Some questions I would ask would be, have they actually handled e-commerce clients before? Ask them what's different about e-commerce versus other industries. Really just trying to find out what their knowledge level is. And then ask them how they handle Amazon inbound payments for bookkeeping purposes. We talked about this before. And if they have no idea what you're talking about, probably not the right guy. Next one is ask them about your business model. Say, hey, I do online arbitrage. Do you know what that is? And if they look at you deer in the headlights and they're like, no, probably not the right guy. uh, you know, another one you could ask them is a question you asked me earlier. What are the rules on cash back? If I have cash back on my credit card, or if I get cash back from Rakuten or some of those other sites, what's the guidelines on that? And if they look at you during the headlights, or they immediately just tell you, yeah, it's 100%, 100% tax, then ask them, all right, how about rewards? How about credit card rewards? If I get if I get like a trip to the Bahamas, and I use my Amex points for it, is it tax deductible? The answer you should get from that is no, it's not taxable. But if they don't understand your question or don't understand that, probably not the right guy either. So really it boils down to, just like anything else, doing your research, make sure you have the right questions ahead of time, and really make sure you're working with someone that truly understands your business versus someone who, yes, they may understand taxes, yes, they may understand bookkeeping, but they truly don't understand your business. And I've worked with, I remember back in the day when I first started, I had a bookkeeper and an accountant that knew nothing about e-commerce. I literally had to figure it out myself because they didn't know. And I had to basically feed the information to them and then just let them kind of finish it. But yeah, that's kind of the key is that you don't want to be that person if you don't understand finance and don't want to learn this stuff because it takes a long time to learn it. You know, I've been around for a while. I don't know everything either. And I've been around for 20 years in this industry almost.
Yeah. Well, I have so many more questions for you, but I know you got to go. Where can people find you on social or wherever else you want them to go?
Certainly. Sorry if I, talked way too much on this call. I knew you didn't get to talk a lot, but so I know
You're
we
the
got a lot of
expert.
questions
That's
by the
why
time.
you're here.
Yeah, definitely. So there's a couple ways you can reach out to me. We do handle bookkeeping, taxes. We also do advisory work on the financial side of things as well. And you can reach us out at talloakadvisors.com. You see my logo here on this side the whole time on this video. So you can definitely see it's the name of our company. Talloakadvisors.com is one way to find it. I'm also very active on Twitter as well, and I put a ton of tips on there
Yeah.
specifically for e-commerce, bookkeeping, taxes, that sort of thing. Give me a follow on there. I'm Chris Potter 361 on Twitter. Maybe just look up Chris Potter, you'll probably be able to find me too. And just love to see you there. And those are pretty much the two easiest ways to get hold of me. You can DM me on there, or there's also you can also schedule a strategy session on talloakadvisors.com if you just want to chat about your business and see how we can help you out.
Cool. Thanks so much for being here. I really appreciate it.
Definitely, it's been a pleasure.
Cool. Thank you.